Hello, everybody, and welcome to your very last lecture of a taped lecture, that is, of the semester, Evaluating a Pharmacy Business. Now, we are going to talk about in this lecture how to evaluate a traditional community pharmacy and its value, and we're going to talk about funding for the bank. In addition, there are several readings, four to be exact, that talk about the same topic as I'm going to talk about, evaluating the pharmacy and opportunities for funding sources for traditional community pharmacies. And then there's a link of an article on other opportunities in funding. And please read them. They are very resourceful and will help you, especially when we talk about our last live Zoom lecture, where we're actually going to evaluate a pharmacy and make some business decisions. So, key things to consider in evaluating a pharmacy business. The first is the location, location, location. The biggest thing of your business, especially if it's a traditional brick and mortar type of business, is it in the right location? Is it near a community? Is it near other businesses that will draw to you, such as a grocery store? Is it near a doctor's office? And the reason you need to think about that is, you know, how are people going to know about you, want to be there? Is it somewhere people go and it's a convenience? But good, great traditional retail locations aren't necessarily always good pharmacies locations. As I said, good community pharmacies want to be in areas where there's anchor other businesses, such as a grocery store. And also, is there at least one primary care physician, some type of ER, med type of express that is going to draw business? The other thing in consider in evaluating a pharmacy business is you have to think about when is it right to be your own entrepreneur and go out and have a business. You need to think about your personal issues. Are you mature enough? Are you ready at this age? Not that a business locks you in that you can't do anything, but in those early days of starting your business, it is going to be the majority of what you do. You also have to think about your lifestyle, your family situations. Those also, is this the right location that you want to grow roots in for the next X amount of years? So you have to look at all those things. The other thing is maybe you don't like the location where the business is at, and would there be an opportunity to move it somewhere close? But if you think about one of the advantages of acquiring an already business that exists is you're building a lot of its good faith, a lot of its already customers. And so moving it may have some benefits, especially if it's a place where maybe there's more parking, a better anchor store, and it's only maybe a half mile down the road. But if you move it too far away, then practically it's a new startup business. Other things to evaluate in acquiring a pharmacy is competition, and not just competition of regular chain pharmacies, other independents that are in the area, or if you're looking at a non-traditional pharmacy, whether it's long-term care, whether it's consulting, what else is out there? Because you also have to look at the virtual competition. Has this business lost a lot to maybe online type of pharmacy? Or the other competition is, what does their contracts look like that they currently are in? What are the major employers in the area, and are those contracts allowed to use your pharmacy? Do they have mandatory mail order? Other important factors is access to the business. How many people can reach it? Is it hard to get to because you got to cross two lanes coming from one side of the highway? Is there a stoplight nearby? All of those things should be taken into account when evaluating, the business. The other thing is, and I will have you do this in your business plan, is looking at the market size and demographics of the area. What is the average income of the area? What's the average age of the area? What is the housing market look like in the area? What is the number of doctors in the area? What type of specialists are in the area? Those all play a big part in looking at, is this a business, especially if maybe I want to get into more disease management type of business, is this the right type of business in this location? There are lots of valuable websites to help you evaluate this. There are U.S. government census sites for the area that you might be in. When I say yellow pages, I don't mean the old archive paper yellow pages, but there are many types of address Google searches or other browser searches you can use. And then there's an interesting company out there called epodunk.com. And this is a place where you can look up a location and look at everything from the average income to what are the most popular disease states, what's the number of doctors in the area, and you can really do help you with your market analysis. And this also helps you with your financial projections when you're looking at growth of your business. Then comes the point, if you want to acquire an already existing business, is what is the value of the business and how can that be documented to satisfaction of all parties to make sure that we're getting a good deal. There is, when selling anything, the market value and the market price. When you get into maybe buying your own house someday, you'll find out that is truly in existence in today's world. Currently, right now, if you've followed anything about the housing industry, housing has gone up immensely due to the low interest rates, and sometimes the market value may be higher than what the market price is. So let me explain. The market value is the value that is ascertained by using one or more of the formulas that can be applied by comparing against other transactions of similar nature. Market price is what are you willing to pay for it, regardless of the stated documented value. So there is, let's use the housing market again, there is what your house is valued at based upon, your taxes, based upon what adjusters see it as, versus if there's a high demand for housing because it's very limited in an area, the market price might be very high. And so, and then the market price is also, what the seller might put it at because they think this is what it's worth. And really, that's not what the value is. And if you don't do your homework, you may overpay for something that is not worth what it is. So there's lots of, in traditional community pharmacy, there's lots of different ways for pharmacy valuation. And I've, in my lifetime, been part of at least two where one was selling and one was acquiring from an independent owner, and had to be part of where we had to close a store and we sold it off to a chain, actually two different times. And so there's lots of different formulas, and I give you an article about evaluating a pharmacy, and it's still relevant today. It's several years old. It's by former Professor Richard Jackson from Mercer University College of Pharmacy. And Dr. Jackson, when you read the article, goes through the different questions of value. And please read through those, because one of the things that you will be doing in our live assignment is calculating the value of the business. So there is, let's go over some of them. There is a multiple of cash flow, income, or profitability measures plus the value of the inventory that sometimes gets taken into consideration. There is, you take a percentage of the annual sales plus the inventory, and this is a good formula. Sometimes it's the only good formula if you have to have comparable stores. Chains do this a lot of times. What they'll do is they'll pay for the inventory, and they'll base the inventory off of what the current market price is, and then they look at what the value of the prescriptions are. And so prescriptions, usually how they determine the value of the prescriptions is how close your business or how close the business is to one of their chains, and how are they able to say that they're going to retain that business? And the closer it is, the more percentage chance of them being able to retain the business, the higher the value per prescription. And when I bring these formulas up here on point number three, this is one of the things you want to share with investors, especially when you're getting funding if you're doing a brand new startup pharmacy. That even if the pharmacy fails, all right, that there is assets already existing that you will be able to sell off to help pay off your loans. And that will be your prescription volume and your inventory. There's also, you know, formulas in Dr. Jackson's article talking about how you calculate what the current owner's, goodwill value is. That this owner has over years, decades, developed a loyal following, and these customers are loyal to them. And this is a value that you're buying of that hard work and goodwill. The other thing is there's formulas out there comparing other transactions similar in nature, and there are also formulas that both business evaluators, consultants, and brokers. And if you're not sure, consulting them too. The other thing is there is no simple formula or rule of thumb, but there are some things you need to be aware of. One, the financial statements of a small privately held company often don't represent the entire picture, both from a positive and negative side. You've gone through your first analysis of financials through our exercises we've done in the past couple of weeks. But one of the things you will ask when you're evaluating a business is getting a set of those financials and getting at least 3 years worth, just like we looked at with Healthy Pharmacy. And the reason why is you want to look at financial trends, just like we did. The other thing you need to do is ask the current owner what is on this P&L that might go away if you purchase the business. So what are some expenses that might go away? The owner might be expensing an additional car which he or she has through the business. They may have some people on payroll that are relatives that you may be able to cut that payroll and don't need. So asking that, the owner may pay themselves less than you would pay yourself just to keep enough cash flow into the business or to show profitability. The owner may pay themselves way too much more, so they have less profit, so they pay less taxes, so they don't get double taxed depending upon how they have their corporation set up. So those are all questions you need to look at. The other thing too is, there are formulas out there that look at multiple percentages of sales, daily, weekly, monthly, annually, and don't take into account varying profitability, and that is why getting 3 years worth of statements. There are formulas out there for multiple percentages of net worth. Those are often difficult to apply in most cases. There are variables in the types of pharmacy operations, and many are complex. The fourth article, which is a link that I talk about investing, talks briefly about that. So, to obtain the value of the pharmacy, as I said, you must obtain the current and historic financials at least 3 years if available, so we can look at trends, sales, margins. Other things that I would ask is get their top 100 prescriptions, their top prescribers, see how many prescriptions they fill. I would also ask for their DIR fees, and I talked briefly in the insurance what a DIR fee is, but these are the penalties that can occur if somebody has poor adherence with their customers, and that can affect their reimbursement on their contracts. And sometimes there are DIR fees in contracts that just aren't fair, but if you have a lot of contracts with high DIR fees, it could really reflect the profitability and cash flow of a business. And so getting copies of those I suggest now, which in the past I never did. I would also see if you can have them break down their sales by department sales and see what else they're selling out front. That I would get a list of their top insurances. What is their Medicare to Medicaid rate? I would also look at their purchase records and their bank deposits to help determine gross margins. I would also look at what their cost to their current software is. Do they update their software? What is the maintenance fees of their software? So you want to really comb through their expenses to determine, are they true actual expenses? Are they maybe expenses that you could change by changing pharmacy systems, pricing out, the different insurances, the different utilities. And those are things that you want to take a look at. And as I said before, factor out non-recurring expenses and costly ownership benefits. So maybe the owner has season tickets to every sporting event, and that is something you're not interested in, and he writes it off as an expense of the business because he takes clients to these games. Those are perks and benefits you can do with a business, but at the same time, they may bring up increase the what the true operating expenses are, and that is why profitability may not look as good as it is. What do buyers need? So here's critical factors to make a deal work. The big three. A buyer, you need the ability to at least draw a managerial salary to get you through those early years and to compensate you for your efforts as you are establishing, reestablishing, and growing the business. The other thing is you need to have the ability to return on any cash investment, that is significantly better than if I just took my cash and put it into a money market fund or a mutual fund or a 401k. I need the ability to service any debt incurred over the course of the transaction. So you're able to pay any loans you may take out to acquire the business. So basically, the three sources of income this current business needs to be viable is to pay a salary, the ability that your net profit, your return on investment, either now or in the future, is going to be well worth it for your efforts, and your ability to service any debt that you may take out to pay your loans. Why are these critical? The seller. The seller is always going to try to demonstrate to the buyer why his or her business is worth what she or he says it is and how it can be paid off. And it's particularly critical when the seller is providing financing of any kind. So I talked briefly about junior partnerships, and one of the things in one of the articles talks about two different roads to acquire funding. One is from a traditional bank. The other one is sometimes the seller may be willing to be the bank, but you want to still come up with a fair agreement that you're going to be able to pay that seller over time. The buyer, you want to feel comfortable that when you or she assumes ownership, you'll be able to earn a living, pay your debt, and build equity. If the economics work, what else is important when evaluating a pharmacy? You want to look at the lease. The longer the better, as long as the rent is fair and affordable. You don't want to get into a business where the lease runs out next year and you find out the landlord was wanting to sell this to the Sheets Corporation to tear down the shopping center to build another Mega Sheets. You want to look at, does the lease have option periods rather than one fixed term? And we talked about leasing earlier in the semester. You want to look at the business itself, the condition, the furniture, the fixtures, the leasehold improvements, the equipment. We acquired a business years ago in the late 90s, early 2000s, and a gentleman wanted to sell, and he was going to sell to a chain traditionally. He was doing about 150 prescriptions, but he hadn't done any remodeling. In fact, the store was rather dusty. It needed a new paint job, and by just getting a couple cans of paint, painting it, getting a couple fixtures, not even brand new fixtures, to make the shelving and the layout better, and getting a good friendly pharmacy, we turned that pharmacy within a year from doing 150 prescriptions to doing 400 prescriptions a day. The other thing is, what is the current state of technology of the business? What's the software of the pharmacy? Is it paid off so that maybe if you wanted to get new software? Is there robotics? What are the robotics of there? As I said before, you want to look at the competition in the area, the demographics of the neighborhood. So you've identified the pharmacy you would like to purchase. So what happens next? What happens next is the negotiation process begins. In the negotiation process, this often can be a first time experience. It can often be a one time experience. It often can be a troubling, difficult experience because one of the things you have to take out of it is you have to try to take out your emotions, even though you're eager to purchase it. You'll feel these emotions in time in the future if you've ever tried to negotiate to buy a car, to buy a house. Those all emotions do come into play, but you have to be calm. It requires skills and knowledge you may not currently have, and that is why you're taking this course, why you may take future courses, why you are going to hire a good accountant and a CPA that understands acquiring businesses, especially pharmacy businesses. You're going to reach out to colleagues, pharmacy organizations that can maybe help you. And because if you're not prepared, it can lead to a less than positive outcome. Who can assist you with this? People that might be willing to lend you money, current relatives that either once bought and sold a business, people that you trust, a good attorney, a good accountant, somebody in the banking business, not necessarily the person you're negotiating, and you also the people that are in your life, your partners, your significant partners, the people that you love, your family. The basis of effective negotiation is being open and communicative at all times. Do your homework. Back up all your statements. As I said before, try to keep your emotions out of the dialogue. And think of that win-win concept for both parties. If things aren't going the way you had hoped, it's not a crime to walk away gracefully. Also be prepared that this process can take longer than you think. It can take anywhere from as short as 6 months to 9 months to maybe a year, to maybe walking away and coming back a year later. Remember that story I talked to you about, that gentleman trying to find his own pharmacy and once trying to acquire it from the hospital? It takes time. Advise and counsel. As I said, knowledge is power. Use the resources you may have available or go get those resources. Accountants, attorneys, bankers, business consultants. Start doing your homework of what wholesaler you might use. Your wholesaler might be able to give you advice. Schools of pharmacy, former professors, small business administration, professional trade organizations. Granted, there's a saying you can get too much advice, but don't be afraid to do your homework. The more you do the homework, the better off you will be. Now, if you go with traditional banking to try to get your startup funding, and as I said, there's a link on startup funding, not just for talking about traditional community pharmacy businesses, but it's also talking about other types of businesses. You have to understand banks. Banks are built with a why shouldn't we and what could go wrong mindset. Banks do not typically attract entrepreneurs, and because they want no risk situations. They want to be able to at least get back what they loaned out along with the interest that they're going to charge. The process with the bank is, one, you want to develop initial point of contact. They're going to require that business plan that you'll be doing next semester if you continue. They're also going to want what type of funding are you looking for and what type of terms are you looking for. And you're going to look at what the current rate for terms are to help determine that. You're going to consult a good accountant for that as you prepare your business plan. There is the underwriting process where they're going to write the rules of the payment terms to pay back the loan and what could happen if it doesn't. There is a loan committee approval process where they're going to look at your credit, they're going to look at your financial stability, they're going to look at your business plan, and then loan committee approval is going to look at, is this something that we shouldn't do, and there's stuff that could go wrong. Because if they find out this is something we should do because it's a sure bet, because it's a solid business plan, it's a solid funding, then they're going to. And finally, they're going to give you a final term sheet. They may appraise the business themselves to see that is this a fair market price that you're getting and not just a market value. And then there's closing documents to be prepared. When you're dealing with the bank, develop that business plan that looks at the worst, mid, best case scenarios. They're going to ask for your tax returns. They're going to ask for the tax returns of the current business. They're going to ask for your personal financial statements. And so, as I give to all students in these courses every year, be careful when you go out. You need to develop and get credit so you can develop a credit report, but don't get yourself in debt where your credit score is going to put you in jeopardy. Because even though there are ways to start a business to protect your own personal liability, they're still going to look at you yourself and your responsibility with credit. When you do your business plan, do business projections. They prefer 3 years historical and 5 years projected. Keep assumptions moderate unless they can be supportive via strong logic. So that is why you do the background research in a business plan, having the detail. If you're going to lease, they're going to want to look at what the lease is. And they're going to look at all the things that we talked about a lease. They're going to may want to see the resume of key personnel that might be involved. And they may also look at how you're going to establish the business, whether it's an S corporation, sole proprietorship. They're going to want to have all that documentation, which you'll be able to get prepared with your CPA and lawyer. The bank will then create a preliminary term sheet. This is not a final answer of yes, but they'll lay out the terms, the interest rate. Sorry, there's a misspelling there. The amortization schedule, which is basically the payback schedule over time. The years the rate is locked if it's not a fixed rate. And they're going to show out what you are actually acquiring in the business. So it's laying out really what the loan would be. And you can reject that if you don't think it's fair. And you may look at multiple banks to make sure you're getting the best pricing. They also may expect collateral. How banks view collateral is crucial. So showing with them that there is already collateral within the business, such as you could sell the files tomorrow if it went out of business. You might be able to sell fixtures in the building. You may be able to sell inventory. These are all assets because if you don't have to show them, they're going to require more collateral from you personally. And that could be down payments, that could be collateral on your own home, and it comes down to how much risk are you willing to take, especially if we go buy through the bank. They're also the bank's going to expect that you will be sharing your financials with them as your business grows. They're going to want to look at your cash flow compared to debt service, and they prefer a cash flow generated by the business to be at least 1.25 times the principal and interest payments. And as we know, pharmacy is a small margin business, but that is why I did the lecture on cash flow for you guys, because it's so important. If you're buying from an existing business, you want to show the calculation of add backs, so things that are going to be taken out of expenses. As I said, banks are in the business of lending money, although sometimes it may appear otherwise. A loan package must appease a number of people, including the regulators. Banks do work together, and education of the industry to banks is necessary, but it can be done. And so hopefully this lecture helped you in determining whether or not these are steps you want to take. There is one other option for acquiring an existing business if it's traditional community pharmacy, and that is junior partnership. And a junior partnership, there is an article that I provided that you'll be able to read about that. And basically what a junior partnership is that you go find a pharmacy business that you're interested in. This is sometimes maybe an owner who's not ready to retire yet. They're going to be thinking about it, but they definitely want to be able to pass this business on, keep it thriving in the community. You then go to work for that person. What you do, though, you usually settle to go to work a little bit less than you would be making if you were working at a traditional pharmacy or chain. And what you're going to do is every year you're going to set up a bonus program. And that bonus program is usually that cut you might have taken or a little bit more if the business can allow. And if that first year you meet your bonus, you take that bonus money and you purchase a percentage of the business. The second year comes, you own a percentage of the business, and so whatever profitability you get from the business plus that bonus, you then put that back in. And the goal is for you to acquire the business, at least 50% of it, within 5 to 6 years. Now, what can I do after 5 or 6 years? There's two options. One, you now have enough equity in the business that if you went to a bank, it's a better sure bet you could get the remaining loan to buy out the current owner. The other option is the owner may want to still be the bank. They're going to walk away from the business, but you would pay them over a period of time, hopefully the same that you can afford, 5 to 6 years, and you then would acquire the whole business. Why would an owner want to do this? Well, an owner, this is an easy way for them to maintain some additional income over the next 5 to 6 years, maybe allow them to retire early till their other investments kick in. And this is a great way for somebody starting out who may not have a lot of capital or a lot of money saved. Over the years of teaching this course, I've had two students acquire their business this way, and I actually have a third in the process of a junior partnership getting that. So please read through the readings. They will be very helpful in understanding this, and I will answer any questions about this topic when we meet during our live Zoom meeting. Thank you.